Assalamu alaikum and hello everyone. Today we are starting a new topic which is cash flow estimations and risk analysis. In this chapter, we will discuss how project cash flows are estimated, what are the techniques for measuring and dealing with risk, and how projects are evaluated once they begin operation. Three topics will be covered in this particular lecture, which is lecture number one. So, the topics are the calculation of initial investment outlays, replacement cost, and the after tax salvage value. We are using Fundamentals of Financial Management by Brigham Houston, and we will cover 12 1, 2, and 3 in this lecture. So, let's begin. First of all, we should know that what is initial investment outlays. So this is the total cash outflow needed at the start of the project, that is at 0 year or at time 0. It is typically includes the cost of acquiring necessary equipment or asset and any additional investment required to support the project, such as working capital. It may also include installation and setup costs related to the asset or equipment, shipping and handling charges, training cost, which is for the use of new assets if it is required. The next is the sunk cost. So, what is sunk cost? It refers to the expenses that have already been incurred and now it cannot be recovered. So these are the sunk cost. Those costs are irrelevant to future decision making because they will remain the same regardless of the project's outcome. So we will not consider sunk cost in our problems as they have already incurred in the past, and it is irrelevant for the current decision making. The next is opportunity cost. Opportunity cost represent the potential benefit lost when choosing one alternative over another alternative. So this cost should be factored into the analysis since it reflects the true economic cost of using any asset, suppose the building or equipment or any other assets. So opportunity cost will be considered in the decision making, whereas sunk cost will not be considered to estimate the future cash flows. So the first problem is 12 1. As I have mentioned, we are using uh, Brigham Houston's book, which is the Fundamentals of Financial um, Management, and it is 8th edition. So this is our first problem. In this problem, we have several data like Truman Industries considering expansion. Expansion means the company wants to expand maybe its production capacity and so on. The necessary equipment would be purchased for $9 million. So this is the acquisition cost of the equipment, and the expansion would require an additional $3 million investment for in net operating working capital. So these are the two outlays. One is equipment cost and another is net operating working capital is required. So tax rate is 40%. So the first requirement is, what is the initial investment outlay? As we have already discussed, these are the outflow related to the investment or expansion, and this is incurred at 0 year time. So time is 0. So now we are going to calculate number one requirement, which is initial investment outlay. Okay, so we have two type of cost that is required: equipment, and other is net working capital investment. So it will be the total initial outlay. So here we have the amount of $9 million. So here we have 9 million. Then we have 3 million investment amount. So it is 3 million, $3 million. So the total, here it is. So the total initial outlay of the investment is $12 million. So this is our first requirement. The second is the company spent and expense 50,000 on research related to the project last year. So remember, this is the cost that company had incurred last year. So would this change your answer? Explanation is required. So uh, no, why it will not affect the answer? Because this is your sunk cost, and sunk cost, which we have discussed, that the cost that has incurred in the past and now it cannot be recovered. So this is irrelevant to the decision making in this particular problem. This is irrelevant with the expansion of the business. So, no, this will not be change or answer at it is a sunk cost. So, next is the company plans to use a building that it owns to house the project. The company is already using a business, and the building could be sold for $1 million after taxes and real estate commission. So company has a building, the company plans to use a building, and the sale value of the building is, or it is the estimated sale value, which is $1 million after tax and other commissions which is related to real estate. So how would that affect your answer? So now, we have two alternatives: whether this building can be used in this project, or this building can be sold to get $1 million after tax. So we have two different alternative for this asset. So this means that this is an opportunity cost. The potential sale of the building, which is 1 million, it represent an opportunity cost of conducting the project in that building. So therefore, the possible after sales price, which is $1 million, must be charged against the project as a cost. So yes, you can say that as this is your opportunity cost, so the cost of you can say $1 million become a part of the project, the cost of the project. So it should be charged, or it must be charged against the project as the cost. So that's it. This is problem 12-1. So before starting 12-2, we will discuss one more thing, which is operating cash flow. So we should know that what is operating cash flows. This is the cash generated from the project core operation of the business. It is related to the main operations, the core operation of the business. So formula is to calculate operating cash flows is sales minus operating expenses minus depreciation. And then from sales. When we deduct sales from when we deduct operating expenses from sales, we get operating income before taxes, and then we deduct taxes to get operating income after taxes, and we add back depreciation because this is cash flows. We are calculating operating cash flows. Why we add back depreciation? Because depreciation is a non cash expenditure. We have to deduct it in order to show the tax impact, but we add it back while calculating operating cash flows. So this formula is used to calculate operating cash flows after taxes while adding back non-cash expenditures like depreciation or amortization and so on. So what are the tax implication in depreciation? As I have mentioned that depreciation is a non-cash expense, means it reduces taxable income without impacting cash flows directly. That's why we are adding it back while calculating operating cash flows. So another concept is cannibalization. What is cannibalization? It is the situation when a project reduces cash flows the firm would otherwise have had. So it occurs when a new product or service or a new project introduced by the company takes sales or revenue away from the company's existing products. This effect is common when a company launches a new product that competes directly with its current offering, potentially reducing the market share and revenue of the older product. So, this is the situation when a new project reduces cash flows the firm would have otherwise have had. So this is the concept of cannibalization. So now we are able to complete problem 12-2 after this concept. So here we have this problem 12-2. So the company is trying to estimate the first year cash flows for the proposed project. The financial staff has collected the following information. Revenue is there, sales revenue is there, um, operating cost is there, but remember this operating cost is excluding depreciation, and depreciation is given and interest expense is given. The company has a 40% tax rate and its weighted average cost of capital is 10%. So first requirement is what is the project's cash flows for the first year. First year project cash flows are required, and here we have the solution. Projects flows for the first year, for year one. So we have sales revenue as we have discussed, operating cash flow. So we have sales revenue, which is $10 million. Then we deduct operating cost as well as we deduct depreciation. So operating cost excluding depreciation is 7 million. And then we have depreciation, which is also 2 million. So when we deduct these two expenses from sales, we get this is your operating expenses before tax, operating income before tax. Okay. Then we deduct tax, which is 40%. You can see here it is 40%. So less income tax, which is 40%. So we take minus dollar 40% of 1 million. Okay, which is 4 lakh. So when we deduct it here, we get operating income after tax because we have deducted after tax. Then now we are going to add back depreciation. Depreciation amount is 2 million. So when we add these two, we get project cash flows or projects operating cash flows. So this is project operating cash flows because now we have not included or we have not considered interest expense in all this calculation because interest expense is a non-operating expense. So that's why we have not included this interest. So, and we add back depreciation because we are calculating cash flows. As we know that it is the depreciation is a non-cash expenditure. That's why we add it back in the operating income in order to get projected net cash flows or operating cash flows, operating projects, operating cash flows. So this is the first requirement. Requirement number B. Requirement number B is if this project would cannibalize other projects by $1 million of cash flows before taxes per year, how would this change your answer in part A? In part A, we have calculated project net cash flows or operating cash flows. Now, we have discussed the concept of cannibalize, which means that it is a situation when project reduces cash flows that the firms would otherwise have had. This means that because of this project, 1 million net income, 1 million cash flows are decreasing, and this is before you can say before tax. So how would this change your answer? So our answer is basically if we have because of this, the net income would be decreased. So what we are going to do? This 1 million, uh, $1 million, this 1 million, um, which is going to be decreased because of cannibalized effect. So we take and this is before taxes. So we simply what we do is to take the impact of tax, or you can say 1 minus t. So we multiply it by 1 minus tax. Tax rate is 40%. So when we multiply it like this, so 6 lakh is after tax impact. Because in the problem, 1 million of cash flows before taxes per year. So now, as this is the reduction because of cannibalize effect. So this is the reduction now which we are going to reduce it, means we are going to reduce it from the operating income which we have calculated earlier, or in requirement 1. Here you can see. So the project cash flows would be 2 million instead of 2.6 million if we consider this impact of cannibalize, that is 1 million of cash flows before taxes. So, if we consider this, then the project cash flows would be 2 million. So, here it is, you can say, project cash flows in requirement number 2. So the next part is B. Ignore part B. Okay, just ignore the impact of this cannibalize. Uh, if the tax rate dropped to 30%, how would change your answer to part A? So here we can complete this one, this requirement part. Um, Here we can copy it and complete it part C. Rest of the parts remain same instead of the income tax portion, which is 30%. So here we replace 40% by just 30%. So answer would be change. Answer would be change in that way that the project cash flows would be increased by 1 uh, lakh or $100,000. You can see previously when the tax rate was 40%, so the project cash flow was 2.6 million, whereas when the tax rate is just 30%, the cash project cash flow is increased from 22.6 million to 2.7 million. That is, it is increased by $100,000. So answer, uh, how would that change your answer? So you can see there's an increase in $100,000. The so that's it, this problem. Next problem is related to salvage value, or so we will discuss a few very basic concept, which is number one is the book value of the asset. So the book value of the assets means represent the value of the asset after accounting for depreciation. So from the cost, we deduct all the accumulated depreciation to get the book value of the asset. And salvage value, which is also known as residual value or the scrap value, it is the amount for which the equipment can be sold at the end of the project. So this is salvage value, and we can calculate capital gains or loss and taxes on salvage value. So the difference between the salvage value and the book value of the asset may be subject to the tax. In this case, if the salvage value is higher than the book value, the difference is treated as a gain and is taxable. Obviously, when your salvage value is higher than book value, this means that your you can say you will get some gain or profit on it, and obviously the profit is taxable. And if it's lower, then there may be a tax saving from a loss. So we will discuss this concept while calculating next problem, which is 12.3. So I'm sharing it with you here. 12.3. So 12.3, it is related with the after tax salvage value. So the company is now in the final year of the project. Now it is the final year of the project. It is the project is going to be concluded. So the equipment originally cost 20 million, of which 80% has been depreciated. Means the equipment is used 80% of 20 million, which is 16, or you can say 1.6 million. So depreciation is 1.6 million. The salvage value is the remaining 20%, which would be the 4 million. And the company sell can sell the used equipment today for 5 million, and its tax rate is 40%. What is the equipment's after tax salvage value? So here we are going to calculate it. We have the cost of the equipment, which is 20 million. So here it is 20 million. Then we deduct depreciation on it, which is 80%, 80% of cost. So here what we are going to do, 80% multiply by the cost, which is 20 million. So 80%. And we are going to deduct it from the cost in order to get the book value. So the book value is 4 million. This is book value. Then we have the company use the equipment today for can sell the equipment, so we deduct, or in other word, we are going to calculate now gain or loss on the sale of equipment. So we have book value, we have cash, or it is the sales price. In fact, it is not, we have not actually received, but the company mentioned that the company can sell the used equipment. So it is, expected sales price, which is $5 million. $5 million, then we deduct book value, which we have calculated, minus 4 million. So then we have the gain or loss, which is 1 million. So this is the gain on sale. Why it is the gain? Because the book value, our books present $4 million. This is the book value. As per the company's record, the equipment at the end of the project would be 4 million, but company can sell it in 5 million. So 1 million, the difference of these two is 1 million, which is the gain on sale of that equipment. So what is required? The main requirement is the equipment. What is the equipment after tax salvage value? So the tax on gain would be, here we have $1 million, and the value of tax is 40%. Here you can see. So we multiply it by 40%, which is 400 $1,000. So we have a book value, then we have gain on sale, and then we have income tax on gain. So last calculation, the last requirement is after tax salvage value. So after tax salvage value would be here. So total gain, the total, you can say the expected price or a total salvage value is 5 million. So we deduct 5, we deduct tax, value of tax from cash receipt. So here, um, this is 4.6 million is your after tax salvage value. So that's it from this lecture. In the coming lecture, we will cover a topic which is related to replacement analysis and optimal capital budget. So that's it from this lecture. Take care, class.